Hello traders, and welcome to lesson 12 in the ReadFX Beginners Forex Trading course. In this lesson then, we're going to answer the question, what are candlesticks in Forex trading? Candlesticks, or candles for short, are a visual representation of price movements over a specific period of time, and they are by far the most popular way of displaying price movements in Forex trading. So let's have a look a little bit closer. So here we can see an example of a bullish and bearish candle. So bullish candle just means a candle that went up, and a bearish candle or a bear candle just means a candle where price went down. Now each candle gives us four key pieces of information, as we know from the previous slide: the open, the high, the low and the close. And this is displayed in the form of a candlestick. Now these were invented 300 years ago in Japan by rice traders, and we still use this system today because it's the most accurate way of displaying these four prices. So let's have a look a little bit closer. So here we see the example of the bull candle, and what I'm going to do now is I'm going to run through each of these points with you to explain how a candle actually works. So the first thing to know is that a candle represents a time frame. Okay, so candles represent different time frames such as minutes, hours, days or weeks. Each candle shows the price action within that specific time frame. So what does that mean? It means that this candle opens and is open for a set duration that you choose. For example, this could be 1 hour. Now what that means is for 1 hour, this candle will record four prices within that hour. So the price that it opened at the start of the hour, the price that it closed at the end of the hour, and it will also record the highest price that it reached within that hour and the lowest price that it reached within that hour. So just by looking at this little candlestick drawing, we get these four pieces of information. The next thing to consider is the shape. So each candle on a chart has a rectangular body, which is this section here, with a thin wick or shadow at the top and bottom, and that's these little wicky bits here. So hence we call it a candle, because it looks like a candle with a wick. Obviously these candles have a wick at both ends, or most candles have a wick at both ends. The body represents the price range between the opening and closing prices during the chosen time frame, while the wicks show the highest and lowest prices reached within that period. So as I just said, price opened here and it closed here. So the area between the open and close will be drawn as the body, and the area that price reached will be drawn as a wick. Okay, so the candle opened here, and what we know is that at some point it came all the way down here, and at some point it came all the way up here, but it eventually closed here. So between the open and the close is the body, and outside of the open and the close, where it got to the highest point, this is drawn as a wick, and where it got to the lowest point, this is also drawn as a wick. The next thing to consider is the colour. So candles are coloured in different ways to indicate whether the price increased or decreased during the time frame. So you remember on the last slide there was a red candle and a green candle. So green candles, you can set the colours to anything you want, but by default a green candle is a bull candle. So in other words, price closed higher than it opened. So if we look here, we can see this is the close price and it is higher than the open price. So this candle will be coloured green, and it is a bull candle because price increased during this time frame. So if this is a 1 hour candle, within this 1 hour period, price went up. Now, if the opposite was true, if the close was below the open, then this candle would be red. In fact, if I go back to the previous slide, so here we can see the bear candle. The open is at the top, so price opened here and it came down and closed here. So the close is lower than the open, therefore this candle is red. Finally, the last thing you should know about candlesticks is that they are used in patterns. So traders analyze patterns formed by candles to make predictions about future price movements. Now candlestick patterns come in many forms. You can have a single candle pattern. In other words, one candle on its own is a pattern. You can have combinations of candles like the ones you see on the screen now, where multiple candles together make a pattern. Okay, and this is part of technical analysis, which we'll start to cover in the next lessons. In this lesson then, we answered the question, what is a candlestick? We looked at the open, high, low and close prices, and we looked at bull and bear candles and wicks. In the next lesson then, we're going to look at candlestick patterns.